Welcome to this explainer. Today, we're unpacking SpaceX's inaugural quarterly report as a publicly traded company. Following its massive $85.7 billion IPO in June of 2026, the data shows the company in the middle of a massive strategic shift, transitioning from an established aerospace manufacturer into a vertically integrated AI-focused tech conglomerate. We're going to examine the verified numbers driving their recent revenue growth and objectively assess whether their current business mix is actually sustainable.
We've broken this analysis down into 6 key areas: the core contradiction, segment economies, bridging the accounting gap, financing the AI buildout, key execution dependencies, and finally, unresolved variables and sustainability. Let's jump right in. Starting with the top-line numbers, and they are striking. SpaceX achieved a whopping 92% year-over-year consolidated GAAP revenue growth, pulling in $7.814 billion for the second quarter. That completely blew past Wall Street consensus estimates. And while they did report a GAAP net loss of $541 million, that's actually a $467 million improvement from the exact same period last year. So we're seeing a very clear narrative of narrowing losses here. But here is where things get complicated. Despite that incredible revenue growth, shares actually dropped about 8.5% in after-hours trading following the earnings release. Why? Well, market commentators are widely pointing to the company reported $18.369 billion in quarterly capital expenditures, or Capex. This is an unprecedented capital outlay that completely dwarfed the consensus projections of $13 billion. It creates a really profound financial tension. They're growing revenue at an incredible pace, but the sheer volume of their capital spending placed the company in a deep negative free cash flow position for the quarter.
That brings us to Section 2. 3 distinct segment economies. To understand what's happening with all that cash, we have to look under the hood. Right now, SpaceX's economics reflect a very clear bifurcation. The connectivity segment is the undeniable profit engine, generating a positive $1.656 billion in GAAP operating income. But that income is heavily dragged down by the operating losses of their other 2 pillars. The space segment posted a $542 million GAAP operating loss, and the AI segment took an even bigger hit with a $1.257 billion operating loss.
Let's zoom in on connectivity first, which is driven by the Starlink network. They reported some seriously strong operating leverage here. The active subscriber base absolutely skyrocketed, doubling year-over-year to 12 million users. On top of that, enterprise and government revenue surged 108% to $1.806 billion, largely fueled by major contracts in maritime, aviation, and defense. But there is a catch. The average revenue per user, or ARPU, actually dropped 22% year-over-year down to $66. This highlights a classic growth versus yield trade-off as they expand the network internationally into more mature markets. Moving over to the space segment, they successfully brought in $962 million in revenue. That's a solid 29% increase, supporting 38 commercial and government launches. So why the massive operating loss? Well, it's strictly tied to development costs. The segment was weighed down heavily by $1.076 billion in company-reported research and development expenses, pretty much entirely dedicated to the Starship heavy lift vehicle program. And then we have the AI segment, which is, by far, the most capital-intensive unit of the whole operation. They did report $2.561 billion in revenue, mostly from AI solutions and infrastructure. But that was completely overshadowed by $15.828 billion in capital expenditures. Those expenses, which they inherited from the February 2026 merger with xAI, were heavily directed toward expanding the Colossus data center in Memphis and buying up advanced compute hardware.
Let's move on to Section 3, bridging the accounting gap.
To really make sense of these numbers, we need to clarify what free cash flow actually is. It's simply operating cash flow minus capital expenditures. Now, this is absolutely crucial to understand. A positive adjusted EBITDA does not automatically equal sustainable cash generation when your capital spending remains this exceptionally high. Adjusted EBITDA is a non-GAAP metric that strips out certain non-cash expenses. It doesn't represent actual liquid cash in the bank.
When you look at the company-reported reconciliation data, you see a consolidated GAAP operating loss of $143 million. But wait, how do they bridge that to a highly publicized $3.538 billion adjusted EBITDA? They do it by adding back massive non-cash expenses, specifically $2.848 billion in depreciation and amortization and $831 million in stock-based compensation.
So while adjusted EBITDA is definitely a helpful way to look at underlying operational performance, it's important to remember that it doesn't pay the bills for immediate hardware expenditures.
So, where is the cash coming from? That brings us to Section 4, financing the AI buildout.
To fund this massive expenditure gap, SpaceX executed a rapid succession of huge capital market transactions. First, on June 11th, the company officially listed on the Nasdaq in an IPO that raised a staggering $85.7 billion. Then, just weeks later on June 26th, they settled a $25 billion inaugural bond issuance across 5 tranches. This debt actually received investment-grade ratings and generated massive institutional demand. Strategically, they used it to refinance $20 billion in outstanding bridge loans that XAI had accrued prior to the merger.
The ultimate result of these financial maneuvers, SpaceX ended the second quarter sitting on a reported $100 billion buffer in cash, cash equivalents, and marketable securities. That is a ton of liquidity for sure. But keep in mind, when your quarterly capital expenditure rate is over $18 billion, that liquidity is substantial, but it is definitely finite.
This transitions us to Section 5, Key Execution Dependencies. For SpaceX to maintain its cash-generating power, Starlink absolutely has to expand its network bandwidth to offset those declines in average revenue per user. To do that, they need to deploy their next-generation V3 satellites. But here's the catch. A V3 satellite weighs roughly 2,000 kilograms. Legacy Falcon rockets simply cannot launch those economically at scale. This means Starlink's future capacity relies entirely on the successful development and the routine, everyday operation of the Starship heavy-lift vehicle. It is a massive dependency.
And it's not just about getting rockets off the pad. There are significant administrative and regulatory hurdles still pending. For example, SpaceX announced a $60 billion all-stock acquisition of the AI coding startup Cursor, but that is still pending regulatory approval. They've also filed an FCC application for a 1 million satellite orbital data center network, aiming to move compute workloads into low Earth orbit. Now, it's important to note that aerospace analysts highly dispute the current economic and technical feasibility of this concept, pointing to launch costs, radiation, and orbital debris as major roadblocks. Finally, the post-IPO share lockup expiration is looming, which will introduce brand new secondary market supply.
Which brings us to our final section: unresolved variables and sustainability. Market analysts are generally framing this earnings report through 2 very distinct scenarios. The bull scenario argues that owning the launch vehicles, the transport network, and the AI compute infrastructure will eventually create a highly durable, vertically integrated platform. They point to Starlink's current profitability as proof that heavy upfront Capex eventually yields massive operating cash flows. On the flip side, the bear scenario cautions that AI and Starship capital spending are simply outpacing monetization. Skeptics note that as subscriber revenue faces continued pressure while data center costs stay at $15 billion a quarter, those cash reserves could drain significantly faster than anyone anticipates. As we analyze all this, we have to separate management's internal targets, like CEO Elon Musk's stated ambition to hit a $100 billion annualized revenue run rate by the end of 2026, from the confirmed financial realities. So, what actually remains definitively unresolved today? First, the true return on invested capital for the AI segment. Second, the final accounting treatment for $14.1 billion in company-reported contracted cloud sales. Third, the actual timeline for routine Starship reusability. And finally, exactly how the broader market will react once that share lockup officially expires.
So let's wrap this up. SpaceX has clearly demonstrated an incredible ability to grow revenue at a 92% rate while narrowing its GAAP losses, driven largely by the success of Starlink. However, top-line growth does not guarantee free cash flow certainty. The central question we have to ask is this: how sustainable is an $18.369 billion quarterly capital expenditure rate when the dependencies for AI monetization and Starship execution are still completely unresolved? The financial evidence shows a company undergoing rapid, monumental structural changes. But the ultimate success of this entire capital structure relies completely on future execution. Going forward, free cash flow trends will be the absolute critical metric to watch in the upcoming quarters.